Good day everyone. Today I will discuss the lesson 1 and 2 of our financial management. In lesson 1, the goals and function of financial management. In this area, we will help to identify what is meant by finance and describe some of its primary areas. Define and compare contrast, sole proprietorship, partnership, and corporation. Identify key advantage and disadvantages of the corporate form of ownership. Define and identify key characteristics of bonds and stock. Define the primary goal of financial management and identify the 3 elements that impact achieving that goal. And lastly, define the concept of agency relationship and explain how they influence the goal of maximizing shareholder wealth. What is finance? There are many definitions of finance, but the purpose of this course, we are going to define it as follows. Finance refers to the process of allocating capital in order to optimize the risk-adjusted expected return on that capital. This can apply to corporate finance while firms are allocating capital across various operations with the firm, making decisions which long-term project they should undertake, develop dividend policy, planning how to raise funding. It can also apply to banking where financial institutions evaluate who to lend money to and how much to charge in interest rate. It can apply to personal finance where individuals develop budgets to manage their spending and make investment to meet future goals such as retirement. Commercial bank, audit, credit unions, insurance company, and countless other financial institutions are an important part of financial landscape. These institutions deal with financial concerns such as risk management, time value of money, financial intermediation, providing short-term and long-term financing to individuals and businesses, payment processing, and other activities critical to financial environment. Banks and other similar financial institutions are among the primary employers in the field of finance. One of the common images associated with finance is the stock market, the field of investments with the stock, bonds, options, mutual funds, futures, and other financial instruments. Some of the key considerations in the field of investment include valuation analysis, risk-return analysis, diversification, and fit. There are many career paths related to investment, including stock analyst, fixed income analyst, portfolio manager, and trader. These careers tend to be very competitive, demanding, and offer the potential for high income. When we say personal finance, it deals with a variety of financial decisions made on the personal level. This includes areas such as retirement planning, insurance, personal budgeting. While personal finance is not the primary topic of this course, it is an important issue for everyone and overlaps with many of the main themes that we'll talk about this class. Due to its importance and overlap with the primary focus, we will spend a fair amount of time this semester discussing personal finance issues. The common career path associated with personal finance is the financial advisor and planner. A financial advisor works with individuals to help them achieve their personal financial goal. Financial planning is an expanding field and it's consistently rated very high to jump ranking evaluation due to combination of potential income and job satisfaction. The term corporate finance, business finance, and managerial finance are often used to interchangeable and refer to the field of finance dealing with the financial decision and making a business perspective. Primary topics of corporate finance deal with the raising of capital, paying dividends, maximizing value for shareholders, and evaluating potential long-term investment that firm will undertake, and managing the firm's cash flow. There are forms of business organization: the sole proprietorship, a partnership, and a corporation. The sole proprietorship is a business organization where the owner is a single person is solely responsible for the control of business. While the owner can hire employees, it is ultimately the owner that is in charge. One important characteristic of a sole proprietorship is that from a legal and tax perspective, there is no real distinction between the owner and the business. The owner is liable legally and financially for the action and liabilities of the business. Also, the income is only taxed once as opposed to be being taxed at both the business and personal level. When we say partnership, structured much as sole proprietorship except that there are multiple owners. Again, there is no distinction between the owners and the business, as they are all liable legally and financially. The income is only taxed once. In practice, there are different types of partnership: general versus limited liability. The general partnership is what is described above. A limited partnership involves at least one general partner to manage the company and take on the risk. The limited partners are passive investors, and a limited liability partnership allows partners to limit their legal limited to each partner's behavior and financial liability, while still maintaining the tax structure of general partnership. And lastly, the corporation. It is a firm owned by many individuals or the stockholders, who in most cases have a little input in operating the firm. A fundamental component of the corporate form of ownership is separation of ownership from the process of managing the firm. The owner or the stockholders elect a board of directors who are responsible for hiring management and overseeing the direction of the firm's operation. There are advantages of corporation. One is limited liability, easier access to capital, and the ability to diversify ownership. And the disadvantages of corporations are higher startup costs and higher levels of regulation, double taxation, and agency costs. The two primary sources of financing for corporations are stocks and bonds. These are essential financial instruments that will help to in-depth throughout the semester. Let us introduce the basic characteristic of these two. Stocks are a form of ownership or equity in the corporation. When you share a stock, you are actually a part owner of the corporation. Large corporations have several million shares outstanding. So when you individual owns 100 shares, they own a little small fraction of the firm. The firm can choose to distribute those profits from back to shareholders in the form of dividends or reinvest them back in the company. Sometimes firms will engage in buying back shares of their own stock as substitutions, dividends as a way to retain profits to shareholders. We need to be careful because there are reasons why firms may engage in buybacks, but the majority firms engage in stock buybacks in 2016. When the firms reinvest the profit back in the company instead of paying them out as dividend, the value of firm should increase, which result in capital gain. Thus, your return from owning stock can come into two sources: dividend and capital gains, because the dividends and capital gains essentially represent your portion of the company's profit. They can fluctuate dramatically over time. Dividend represent portion of profit that is currently being paid out, while capital gains are dependent on investors' expectation for future profit. Bonds are form of debt. When you buy a bonds, you are lending their issuer money. The loan is structured so that the bondholder receive a fixed interest payment every 6 months until the bond matures. At maturity, the bondholder receives that the last coupon payment and the par value like dividends. Promised coupon payments on the bond must be made to bondholders on time or the company can force into bankruptcy. Bondholders are first in the priority of payments and must receive their promised payment before the stockholders get anything. Due to, due to this priority of claims, the fixed cash flow stream, and the fixed time horizon, bonds are considered lower risk than stock. Given this lower risk, bonds will typically have lower expected return. There are B exemptions where the bond of a firm that is exhibiting the financial stress may be riskier and have higher expected return than the stock of large. Again, a lower expected return does not mean a lower return of any particular bond or bonds in general a particular year. In a given year, bonds can earn higher returns than stocks, but typically over longer periods of time, stock usually earn higher returns than bonds. The goal of financial management. The goal of financial management is to maximize the current value per share of the existing stock. In this goal seems a little strong or one-dimensional to you. Keep, up, keep in mind that the stockholders in a firm are owners. By this, we mean that they are entitled to only what is left after employees, suppliers, and creditors are paid their due. If any of these groups go unpaid, the stockholders get nothing. So the stockholders are winning in the sense that the leftover portion is growing. It must be true that everyone else is winning also. These are the secondary financial goals. Setting short-term, mid-term, and long-term financial goal is an important step toward becoming financially secure. If you aren't working toward any specific, you're likely to spend more than you should. You'll then come out short when you need money for unexpected bills, not to mention when you want to retire. You might get stuck in cycle of credit card debt and feel like you never have cash properly insured, leaving you are vulnerable that you need to be handle some of the life's major risks. Survive, avoid bankruptcy, minimize costs, maximize profit, and maintain steady growth. The objectives of financial management is about creating profit of business and ensuring an acceptable return of investment or ROI. Financial management is accomplished through business financial plans, setting up financial controls and financial decisions. And that's all for our lesson 1. We go to financial statement analysis. The learning objective of this lesson are as follows. Discuss the purpose and key issues associated with an income statement, balance sheet, and statement of cash flow. Identify the 3 components of cash flow. Calculate and interpret financial ratios. Calculate and interpret income statement and common size balance sheet. Discuss and apply concept of trend analysis, including both its strengths and weaknesses. Discuss and apply the concept of comparative analysis, including both its strengths and weaknesses. Identify the key user of financial statement analysis. Identify potential strength and manage and weaknesses for a firm given financial statement for the firm and industry, and discuss and interpret the many issues associated in financial statement analysis. There are key financial statement, income statement, balance sheet, and statement of cash flow. The income statement provides information on a company's revenues and expenses over a specific time period, usually annually or quarterly. These revenues and expenses are accounting-based and not necessarily reflected on cash flow generated. For example, when a long-term asset is purchased, the cash is spent at the time. However, its expenses are recognized over time as depreciation instead at the point of purchase. Also, the method chosen to account for inventory cost discrepancy between net income and cash flow for operation. The cost of our inventory is recognized when it's sold, not when it is paid. While the income statement is not cash-based, that does not imply that is meaningless. It also provides a good picture of how well the company is doing. But we must recognize that net income is not a cash. The balance sheet provides a snapshot of the company asset, liabilities, and owner's equity at a specific point in time. The company asset must be financed by either debt, liabilities, or ownership interest or the equity. Therefore, asset will always equal liabilities plus owner equity. It is important to remember that the values reported on the balance sheet are book values and do not necessarily represent the market value of the asset or ownership interest by the variety of reasons. The statement of cash flow attempts to reconcile the difference between the income according to generally accepted accounting principles and cash flow. Cash flow are broken down into primary areas: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. When we say cash flow from operating activities, this is the most critical component of the statement of cash flow. Cash flow from operating activities provide insights into well the firm is doing generating cash flow from its day-to-day operation before factoring in any capital investment or finances issue. This is done by starting with net income and then adjusting back to cash-based version of income. Operating cash flow can be negative due to a short-term operating problems that are being addressed due to economic and industry issues or due to more significant operating problem. The impact on the firm will vary depending on how likely the negative operating cash flow are to be short-term versus a long-term issue. Growth, while less than important, is also something that is analysts or management want to address if it is stagnant or declining. When we say cash flow from investing activities, it is important for a firm to operate as a going concern, which means that they need to invest in their business. This may be updating long-term assets that are going worn out, spending money on new equipment to improve productivity, or spending money on expanding the business. These investments into long-term assets are commonly referred to as capital expenditures and are essential to a firm remaining competitive and successful. They are also a key element in cash flow from investing activity segment of the statement of cash flow as they represent investment in the company. Because the firm is spending money on this investment, they will typically be negative. While we want cash flow over to be positive, negative cash flow from investing activities are not in a concern and instead are essential part of firm's long-term success. The reason for concern will be if a firm is investing in its long-term asset or in spending too much or unproductive asset. These both can be difficult to identify the short run as they are often lag between investment are made and when the payoffs show up in the cash flow from operating activities selection. And lastly, the cash flow from financing activities. In a firm generates more cash flow from operating activities than it spent on investing activities. It can have cash left over the return of investors. Alternatively, if a firm spends more cash on its investing activities that is generates from operating activity, it will need to raise additional cash from investor. In this area, that can be much about where firms is in growth cycle as it is about the firm's health. Typically, a younger firms and rapidly growing firms need to spend a lot of cash spending the business and may not enough operating cash flow to fund those investing activities. Financial statement analysis provide a wealth of information to many different users. There are many ways to analyze a financial statement. This includes ratio analysis and common size statement, both of which can be analyzed through trend analysis or comparative analysis. While a ratio analysis and a common size statement provide an excellent way to analyze the information in the income statement and balance sheet, the statement of cash flow is best analyzed by breaking into its three primary components. The key financial ratios relies on extracting data from corporate financial statement to compute various ratios. And there are 5 basic ratios that are often to pick up stock for investment portfolios. These are price earning, earning per share, debt into equity, and return on equity. Working capital ratio represents a company's ability to pay its current liabilities with its current asset. Working capital is an important measure of financial health since creditor can measure a company's ability to pay off its debt within a year. Working capital represents the difference between a firm's current asset and a current liabilities. The challenge can be determining the proper category for the vast array of assets and liabilities on a corporate balance sheet. The overall health of a firm meeting its short-term commitments. Assessing the health of the company in which you had to invest involves understand liquidity, how easily that company can turn asset into cash to pay short-term obligation. The working capital ratios is calculated by dividing current asset by current liabilities. When we say quick ratio, it is also called as acid ratio. This ratio subtracts inventory from current asset before dividing that figure into liabilities. The idea to show how well current liabilities are covered by cash and by items with ready-to-cash value. Inventory, on the other hand, takes time to sell and convert into liquid asset. When we say earning per share, when buying stock, you participate the future earning or the company earnings per share. Measure net income earned on each share of company's common stock. The common analysis divides its income by weighted average number of common shares outstanding during the year. If a company has a zero or negative earnings, then earnings per share will also be zero or negative. Price earning, it is called called for chart as PE, this ratio reflects investors' assessment for those future earnings. You determine the share price of the company's stock and divide it by EPS to obtain the PE ratio. If the company has zero or negative earnings, the PE ratio no longer makes sense and will often appear as NA for not applicable. The debt-equity ratio calculated by adding outstanding long and short-term debt and dividing by the book value of shareholders' equity. Let's say XYZ has about 3.5 million worth of loans and had shareholders' equity of 13.3 million. That works out to a modest ratio of 0.23, which is acceptable under circumstances. However, like other ratio, the metric has to be analyzed in terms of industry norms and company-specific requirements. Trend analysis is a ratio presented above close to meaningless by themselves. Looking a single ratio in isolation is about as useful as physician trying to perform a diagnosis simply by looking at your temperature. It is a technique used in technical analysis that attempts to predict future stock price movement based on recently observed trend data. Trend analysis is based on the idea that has happened in the past gives traders an idea of what will happen in the future. Due to seasonality in quarterly financial statement and annual balance sheet, seasonality concern may lead to distortions in trend. We must be aware of how seasonality can impact our ratio and common size statement before we can properly analyze trend. What is comparative analysis? It is another way to make the ratios and common size statement meaningful is to compare them in industry average or the key competitors. For example, labor-intensive industry have high return on asset numbers while a company in capital-intensive industries may be relatively low return on assets. Also, grocery stores are likely to have higher cost of goods sold values as a percentage of sales than the software developers. If you are analyzing in a software developer, it is important to compare to those others in the industry to determine the numbers are good or bad. If our numbers compare favorable to the industry average, that is good sign. And the numbers that compare unfavorable to the industry average indicate potential weaknesses. However, we must be careful here. Our goal is not to be average. If we are better than the industry average in that area, that does not mean we have no room for improvement and management should ignore the area. The long-term lenders. These main types of long-term debt are term loans, bonds, and mortgage loans. Term loans can be unsecured or secured and generally have maturities of 5 to 12 years. Bonds usually have initial maturities of 10 to 30 years. Mortgage loans are secured by real estate. When we say short-term creditors, like a long-term lender, short-term creditors are focused on the firm's ability to repay its ability. However, they are less concerned with the debt management ratios and more concerned with the liquidity ratios. Whether the firm can meet their long-term obligation is less relevant as long as the firm can generate enough cash flow to meet their current obligation. Stock investors. Stocks are equity investment that represent part ownership in the corporation and entitles you to part of the corporation's earning and asset. Common stock gives shareholder voting rights but no guaranteed dividend of payments. Before you buy your first stock, you should master the basic of stock invest. Who uses financial analysis? The answer is the many different groups of individual and institution who are concerned with identify the health and performance of the company. This includes, but not limited to the following group: the company management, competitors, long-term lenders, short-term creditor, and the stock investors. And